Be Wealthy and Smart, episode 729.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. Well, on Friday, the big news was that President Trump came out and took some action against China. And what we want to talk about today is what might be the repercussions of those actions and how that might impact your portfolio or your holdings in your portfolio. So I want to share with you an article from Investors Business Daily, and it says, "The U.S. targets Chinese stocks. Are you exposed to a rising risk?" And it was written by Matt Krantz. And it says, the U.S.'s relationship with China is souring. Now is the time to know your exposure to Chinese stocks. Congress's early threat to delist some Chinese companies trading on major U.S. stock exchanges is the latest salvo in the war between nations. More than 200 China-based companies, with Alibaba, symbol BABA, being the largest, and JD.com, symbol JD, and Pinduoduo, symbol PDD, being top performers, hold either a primary or secondary listing on a major U.S. exchange. And these U.S.-listed Chinese stocks are significant. They represent $1.3 trillion in market value. None of these stocks is in the S&P 500, but they still find their way into portfolios. The U.S. Senate approved rules that, if enacted, submit companies listed on U.S. exchanges to a U.S. audit, said Todd Rosenbluth, head of ETF and mutual fund research with CFRA. Congress could force delisting of Chinese companies from U.S. exchanges, Rosenbluth said. The impact on index-based emerging market ETFs could be significant. And even if Chinese stocks aren't delisted, some may get caught up in the world's gradual scale back in globalization and free trade. If there's a Chinese stock in your portfolio, it's likely Alibaba, BABA. The e-commerce giant is valued at more than $500 billion. That makes the company more than 5 times larger than the next biggest U.S.-listed Chinese stock, PetroChina, symbol PTR. Given Baba's size and the company's outsized influence, it's in 153 exchange-traded funds, said Dave Nadig, Chief Investment Officer at ETF Flows. And it's a 10% holding in 13 ETFs, Nadig says. For instance, the Invesco BLDRS, Emerging Markets 50 ADR Index Fund, puts a near 20% weight in Alibaba, Nadig says. Given the strong growth of Chinese stocks, it's no surprise they account for large slices of emerging market ETFs, and emerging market funds are commonly held in most global portfolios. Holdings in Chinese companies top all other countries in popular emerging market ETFs. The $52 billion Vanguard FTSE Emerging Markets ETF, symbol VWO, puts 9.6% of its assets in mainland China companies, and it holds an additional 34% in Hong Kong. Wow, I just want to pause there because although the action that the president has taken is against China in order to help Hong Kong, it is going to impact companies that trade on Hong Kong stock exchanges. So because we have up to 20% weight or more in China holdings and then another 34% in Hong Kong holdings, a more significant amount of your international ETFs or your emerging market ETFs could be in China and Hong Kong without you really realizing it. The article goes on to say stakes in China-based companies account for 37% to 43% of assets in most emerging market ETFs, Rosenbluth says. Just owning the S&P 500 will keep your portfolio out of China. But there are other ways to kick China out of your portfolio. The small 14 million in assets Freedom 100 Emerging Markets ETF, symbol FRDM, weights its holdings based on countries' value of life and liberty. It leaves out China. You can find ex-China exposure in a few ways, but FRDM is my favorite. It's freedom weighted and China doesn't make the cut, Nadig says. A larger ETF that avoids China is the iShares MSCI Emerging Markets ex-China ETF, symbol EMXC. It has $39 million in assets and has a higher weight in Taiwan and India than most other emerging market funds, Rosenbluth says. It offers an expense ratio of 0.25%. Investors in emerging market ETFs and mutual funds likely are aware they own shares in many Chinese companies, but may not realize that Baba, Baidu, JD, and others are listed here in the U.S., Rosenbluth said. We think a focus on the holdings matters. And then they have a table here in the article, and it says, key China stocks, most valuable Chinese stocks on U.S. exchanges. So if you have any of these in your portfolio, you need to sit down and take a look and decide if you want to keep them in your portfolio, because there is a rising risk of holding on to Chinese companies. These companies may be forced to delist from U.S. stock exchanges. And by that, I mean that what President Trump said is that Chinese companies will have to abide by U.S. securities rules. You see, every other country and all companies have to abide by U.S. financial standards, that is, except China. Every company that's listed on the stock exchanges usually has to have audited financial statements, except China. China has been given special liberties to not share its finances with investors. Therefore, we don't really know what their real profits are. We don't know what their real revenues are. We don't know anything about the financials of these companies. And therefore, they will either comply with U.S. regulations and reveal that information, or they won't. The problem is that some of those companies in China are state-owned companies or state-run companies, and therefore it is considered treasonous to share financial information with anyone. So by definition, then, they will have to delist from our U.S. exchanges. So there is rising risk. Remember, we did see Luckin Coffee, who was supposed to be the Starbucks of China. Their stock nearly went to zero. So the risk is high. I want you to be aware if you own these stocks, you are doing so at higher and higher risk. And if you own these ETFs, if you own an emerging markets ETF, it's likely that at least 20% of your emerging markets ETF is involved in China, if not more, because Hong Kong may also be impacted negatively. And if you have international ETFs or mutual funds, you probably have at least 10% invested in China in those funds. So in this chart, it says the most valuable Chinese stocks on U.S. exchanges are Alibaba, ticker BABA, PetroChina, symbol PTR, China Life Insurance, symbol LFC, JD.com, symbol JD, Pinduoduo, symbol PDO, China Petroleum, symbol SNP, NetEase, symbol NTES, Baidu, symbol BIDU, TAL Education, symbol TAL, and ZTO Express, symbol ZTO. So personally, I don't own any Chinese stocks in my portfolio. I don't plan to, and I would caution you if you consider holding them for much longer, because once the House votes on this law, which does have bipartisan support and has already passed in the Senate, this law will go into effect, and we may see some swift action taken against Chinese companies. So I wanted to make you aware of that and let you know what's happening. This is an ongoing situation that I'll be updating you on and reporting over time. Don't take my advice. Check with your financial advisor and see if it makes sense for you. But I did want to make you aware of rising risks that are occurring in certain aspects of our stock markets. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.